Hi, Professor Rex here. In this week's video, I'm going to focus on the simple tech stock portfolio my accounting students and I started in 2024, April to be exact, as outlined here in red. I'll also talk about two new strategies that I'm experimenting with, capital light companies and wide-moat stocks, which is a simple way to ensure you're only investing in companies with the strongest competitive advantages. We'll also talk about a possible sector rotation strategy. And if you're interested in dividend growth stock portfolios on the far left, I've started a completely free Substack featuring that portfolio to see if I like the Substack platform. You can sign up and see which dividend growth stocks we're buying in real time on Mondays. But let's get back to our tech stock portfolio outlined in red on this slide. It's a real-world investment portfolio where I make additional investments on the first trading day of each week. It's by far our most volatile portfolio because it's not diversified since it only invests in one sector. And tech stocks, by their very nature, tend to be very volatile. Also, it's our newest portfolio, so its performance will fluctuate up and down more so than our other portfolios, which have longer track records. Our tech stock portfolio so far has an annualized return of 17.37% versus its benchmark's return of 14.98%. This portfolio had a huge month in May, but cooled off a bit this week. In next week's video, we'll talk in depth about our dividend stock portfolios that my accounting students and I started back in 2022 and 2023 as outlined in yellow. Like our tech stock portfolio, they are real-world investment portfolios where I make additional investments on the first trading day of each week. So in effect, they are accumulation portfolios mimicking someone in their working years who is consistently adding to their investment portfolios. And as a reminder, the portfolios on the far right in the light blue outline are portfolios that I started in 2003 when I was in college. These portfolios are more buy and hold portfolios with infrequent trading, so their lack of action might make for boring videos. But you can go online to read more about them if you like less frequent trading. You can read about them at beatthestockmarket.com. So here's a summary of our investment strategies, their annual returns, when they were started, and where you can find them. The dividend strategies are my personal favorite since my goal is to generate passive income that is twice my annual expenses. The dividend growth stock portfolio seems to be the most popular, so I put it on Substack for free as an experiment to see if I like the Substack platform. So far, Substack is easy to use and is turning out to be more fun than I expected. You can also find the dividend growth stocks that we're buying on the first trading day of each week, either on Substack or my website, beatthestockmarket.com. So in this green box, there's a note that I've added that these strategies, these three strategies are newer, and therefore the average investment has been held for less than a year. This means their annualized returns will fluctuate a lot until the holding period eventually grows. For example, the capital light strategy, as you can see down here, is by far the newest as it was started in February of this year. And as you can see in the bottom table, the average investment in the capital light strategy has only been held for 68 days and has a return of 4.34%. Now this annualized return of 25.78% should be taken with a grain of salt since the holding period, 67 days, is so short. So all this 25.78% means is if a stock's price increases 4.34% every 67.7 days, you get an annualized return of 25.78%. Will it continue to do that well? Maybe not, but we hope it keeps beating the S&P 500. So here's a weekly chart of how our weekly investments into our model portfolio of tech stocks has been growing. It's as of last Friday. We invest $12.50 each week and buy 10 different tech stocks on the first trading day of the week. And the ratings for stocks changes weekly, so the list of stocks we buy each week fluctuates. So here's the usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own due diligence, which means do your own research. So let's talk about the tech stocks we bought last week. On this slide are our ratings for the top 15 tech stocks as of last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday, and then we purchased the top 10 stocks. Remember, we buy 10 stocks each week. Note that all these stocks are higher quality, meaning they must have a quality ranking of B- or better. More on what makes up our quality grade on the next slide. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend growth stocks, because some tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc. So our highest rated tech stocks last week were Adobe, Accenture, Analog Devices, Intuit, ASML, Arista Networks, Motorola Solutions, Apple, Salesforce, and Microsoft. And on this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio. Risk is the first quality component. Tech stocks, by their very nature, tend to be riskier than most other sectors. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported earnings. Remember, earnings is just another way to say profits. And finally, the last quality component is financial health. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. Now, one reason why tech companies have been outperforming the market for several decades might be because they tend to require little capital. As a simplified example, if you want to start a software company, you just need a computer and software knowledge. On the other hand, if you want to start manufacturing cars or jets, you're going to need a lot of buildings, a lot of equipment, a lot of employees, etc. In other words, a lot of capital, which is very expensive to obtain and maintain. Goldman Sachs recently published a research note that shows that the companies that do not require a lot of capital have significantly outperformed companies that employ heavy capital by 544% during the period of 1990 to 2024. The research calculated capital intensity based on three formulas: assets divided by number of employees, assets divided by net income, and capital expenditures divided by net income. After finding this research note, I contacted the authors and discovered we might be able to get even better results because in the study, they ranked and classified companies based on 45 sectors, and I believe there's 12 sectors in the U.S. traditionally, but they have 45 sectors, so I would consider those sectors as more like industries. Anyway, they ranked and classified companies based on the 45 sectors of the ICB taxonomy, not on individual companies. Not only did they look only at the sectors, they took the sector's median since 1990. So if the sector's capital intensity changed over the years, they ignored that. The authors admitted that sectors that were once capital light can become capital heavy and vice versa. And they admitted that within a given sector, one company may be capital light while another is capital heavy. But they ignored that too. I'm assuming they did this to save time because otherwise they would have to look at each individual company's factors for each month or week and then do this for each and every year in the study, which is a lot of work when you're looking back over 30 plus years. So it seems their study could have had even better results if they dug deeper and looked at companies specifically instead of sectors in general. And we can do this in real time going forward on a weekly basis. So that's what we have been doing. We're looking for individual companies that are capital light, but also high quality. And our capital light rating is based on individual companies, not whole sectors or industries. On this slide, I have a list of S&P 500 companies that are capital light, high quality, and appear to be undervalued using a growth methodology. These are also the capital light stocks we bought last week. Similar to our high yield stock portfolio, which we talk about in other videos, we're using two strategies for this portfolio. Strategy 1 in red emphasizes how undervalued a company is, while strategy 2 in green includes quality as a factor. So you will usually see higher quality companies in strategy 2. It will be interesting to see which strategy does better in the long run. So far, the portfolio is ahead of the S&P 500, as we saw early in the video, but it's very early in using this strategy. So for this slide, I started with a list of over 4,300 companies, and the first step was to filter out the companies that were capital intensive based on the three formulas that the authors used in the study. So here's a strategy I started tinkering with behind the scenes in September of 2023. It's the WideMoat stock strategy. So it's not the most diversified portfolio, so I decided to wait longer to share the results. First of all, what is a moat? Well, Morningstar is a service that rates stocks and is famous for its moat rating that it assigns to large companies. What is a moat rating? A moat rating attempts to simply measure the competitive advantages of a company. If a company has no competitive advantages, then it's very easy for another company to enter the industry and take customers away from that company. They call it a moat rating because they liken it to a moat around a castle. If the moat is wide, then it's harder to storm that castle. If the moat is narrow, then it's a bit easier to attack the castle. And if there is no moat, then the castle is much easier to attack. So this strategy invests only in the companies with the best competitive advantages. In other words, the widest moats. There are limitations to the moat rating, and I prefer my own quality ranking system that takes much more data into consideration. But the moat rating is a kind of a quick shortcut way to invest only in high quality stocks. On the next slide, you'll see my ranking of the top 15 companies with wide moats. But first, let's talk about the strategy's performance. Like the tech stock portfolio, I have been making weekly investments into this portfolio. I originally had this strategy in a Fidelity portfolio with a few other strategies, but quickly learned that having that many strategies in the same account makes it a nightmare to track their performance separately. So I sold off those holdings and have since started a Fidelity account dedicated solely to this WideMoat strategy. The average investment so far has been held for less than a year and has produced a total return of 19.59%. Using Excel's rate function, that's an annualized return of 44.64%. Now, the strategy does not result in the portfolio with as much diversification as most of our other strategies, so the portfolio's performance could fluctuate a lot, and the performance likely won't stay that high because stocks historically average a total return of about 10% a year. Now, Morningstar offers an ETF that only invests in WideMoat stocks, so that ETF is a natural benchmark or comparison for this strategy. Its ticker symbol is MOAT, M-O-A-T. If we'd instead invested in MOAT on the same exact days that we made our investments, we would have received a return of 9.98% with the same holding period. Using Excel's rate function, that's an annual return of 21.60%. So our WideMoat strategy is basically doubling the annual return of the Morningstar ETF so far. The strategy is also beating the S&P 500 by 18 percentage points on an annualized basis. Now let's look at our ranking of the best WideMoat companies. In other words, companies with the strongest competitive advantages. The valuation methodology here is a growth methodology, not a deep value methodology. Now, unlike our dividend growth portfolio where we want a lot of diversification, for this portfolio we only buy the top 5 stocks each week instead of the top 10, and we don't limit how much an individual stock can be in the portfolio. So this portfolio is less diversified and more aggressive than our dividend growth stock portfolio. Remember, stocks in any of our strategies may appear on this list one week, but not appear the next week as they might barely miss a screening criteria such as earnings estimates over the next 12 months, which changes frequently. And just because a stock falls out of the ranking one week rarely means that we plan to sell the stock right away. Sales tend to be rare. So the 5 companies we bought last week were Arista Networks, Salesforce, Copart, Constellation Brands, and Thermo Fisher. Now, one advantage of companies with the best moats is if they pay dividends. They are more likely to increase dividends even during an economic shock when compared to companies with no moats. Now, on this slide, Morningstar shows there are 3 categories of moats. On top, we have the companies with wide moats, which is considered the best. This slide shows that during the 3-year COVID period, when supply chains ground to a halt and some companies saw a collapse in sales, about 80% of WideMoat companies were able to raise their dividends despite many companies being in financial trouble. Only 18% or so cut their dividends. Now, for companies with no moat, which is on the bottom of the chart, only 57% or so were able to raise their dividends, while over 30% were forced to cut their dividends. For that reason, many of our strategies only invest in companies with either a wide or narrow moat. While our quality ranking for stocks includes moats, it goes much deeper than just one metric. But if you want a simple metric for quality, moats are a good place to start. Of course, this slide only covers a 3-year COVID period. During normal periods, dividend cuts are much more rare, and on average, companies increase their dividends 5.5% to 6% per year. So let's talk about a potential sector rotation strategy. The Center for Financial Research and Analysis suggests to overweight the Center for Financial research and analysis suggests sectors to overweight and sectors to underweight. Currently, they have an overweight on the communication sector in green, financials, and information technologies. They claim that they have a sector rotation model portfolio that is based on the sector weighting recommendations seen on this slide, and the portfolio has a 30-year trading history. Since its inception in 1995, the sector outlook model has had a 63% hit rate, meaning it beat the S&P 500 63% of the years, and has outperformed the S&P 500 index by 4.4 percentage points on average per year. Now, does that mean they only invested in the overweight sectors, or do they just allocate more to those sectors? I haven't found out yet. More research is needed. Now, a week ago on Friday, the Center for Financial Research and Analysis made 2 changes to their weightings. They upgraded the energy sector from underweight to market weight because of the new conflict in the Middle East. And they lowered the healthcare sector to underweight because of elevated policy uncertainties, to quote them. Now, looking deeper into the sectors, I noticed within each sector they have outlooks for each sub-industry. For example, even though they have an overweight recommendation for the communication sector, only 30% of the sub-industries within the communication sectors have a positive outlook. In other words, could we possibly do better than the 4 percentage points per year of outperformance if we only invested in those positively rated sub-industries? Let's look into that a little more. We'll break out one of the sectors on the next page. So here we're looking at the 7 sub-industries in the energy sector. Remember, the energy sector recently was upgraded from underweight to equal weight. But as you can see, they only awarded one of the sub-industries in the sector with a positive outlook, and that's down here at the bottom, oil and gas storage and transportation. But as I mentioned earlier, could we possibly do better than the 4 percentage points per year of outperformance if we only invested in the positive sub-industries? If so, which stocks in those sub-industries might be the best stocks to buy? So we'll look at that on the next slide. We'll look at the oil and gas, storage and transportation stocks that I would consider to be the best buys. So on this slide, we're looking at what I believe are the best stocks in the energy sector's oil and gas, storage and transportation sub-industry, as you can see right here. If I were to employ a sector rotation, I would buy Cheniere Energy if I was not concerned about dividends, since their yield is only 0.8%. So this sub-industry is famous for having some of the largest dividend yields, if not the largest. But Cheniere is different. They have less than 1%. Now, Cheniere barely ranked higher than Enterprise Products Partners, which is my second rated. If I were interested in receiving income, I would choose Enterprise over Cheniere since it has a 6.86% dividend yield. However, if I did not want to have to deal with the tax complications of master limited partnerships like Enterprise, I would go with tickers OKE, KMI, or ENB instead. And again, this is the order I ranked them, and LNG barely beat out EPD. Now, in our last video about sector rotation, we covered the communication sector. It has 3 positive ratings on the sector sub-industries, and they are down here in green: interactive home entertainment, interactive media and services, and movies and entertainment. So on the next slide, we'll look at these, what I consider to be the best picks in those 3 positively rated sub-industries. And they're the same as last time. For the interactive home entertainment sub-industry, I would go with electronic arts. For interactive media and services sub-industry, I would go with Alphabet, ticker Google. And for the movies and entertainment, I would choose between Disney or Netflix, or if you want, you could buy both. So that's it for now. In the comments, let me know if you have any questions, and also let me know what portfolios or investment strategies or sectors you would like to see more of, or if there's a particular, I guess I just said that, or if there's a particular sector you would like to look at next time. And finally, here are the places you can reach me. YouTube, obviously, as well as our website, beatthestockmarket.com, Substack, LinkedIn, and Twitter. I'll see you again next weekend, likely with a list of dividend stocks we'll have purchased on Monday. See ya!